Good day, Market Chameleons, and everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon webinar series. Before we get started, let's take a look at the shared disclaimer. Be aware that neither Market Chameleon, Dimitri, or myself are registered investment advisors or a broker-dealer. If you're searching for investment advice, please reach out to a licensed professional. This show, like all our shows and webinars, are for informational purposes only concerning Market Chameleon tools and products. With that, one last look at the disclaimer, and let's welcome Dimitri Pargamonic to the stage. We'll be talking about implied volatility versus historical volatility benchmarks. How you doing, D?
Good morning, Will. How are you?
Good.
Let me share my screen here. Good morning, everyone. And I think today we'll quickly go over volatility benchmarks, implied volatility, historical volatility, and how, as a trader, you could use them to make a quick assessment of where the general implied volatility is in a stock. And let's kind of go to a example here, what we mean. And I'm going to go to a symbol. Let's type in Google. This will take us to a Google summary page. And the idea here is when we look at a stock and we're looking and we're thinking about the options, and without doing in-depth research, we want to know in general, where's the implied volatility of Google right now? Because the implied volatility, it comes from the option prices, right? So Google has different, or every stock has different expirations, different strikes. So they're all going to have different implied volatilities. And to go in there and look at all these implied volatilities and figure out, are they on the high end, low end? It's going to take a lot of research and looking through. And if you're just trying to get a sense of where we're at right now, we have to look at certain benchmarks. And one of the industry standard benchmarks is a 30-day constant maturity implied volatility, because we have to pick an expiration. What are we looking at? A 7-day, a 90-day, a 23-day option, right? Because all these options are going to they have different days to expiration. So we have to kind of keep it constant to be able to compare how it's changing over time. Think about like a 30-year mortgage versus a 15-year mortgage. So they might be different, right? Or a different term. The rates could fluctuate and they're different. So we need to establish kind of a constant maturity benchmark. So we look at the default is like the 30-day, kind of like the VIX. But we could look at other benchmarks like 90-day, 60-day. But let's start out with the 30-day. And then we have to kind of say, well, are we looking at options that are close to at the money? Are there options that are wings, like, out of the money puts, out of the money calls? You have like tails very far out of the money. So to establish a benchmark, the most common benchmark is at the money, the implied volatility that is right around where the stock price is. So if we create this benchmark, right, and here it is over here, 30-day IV, this is yesterday's implied volatility. Okay, now we could kind of track what it's doing throughout the day, previous day, and so forth. And keep in mind, these are calculated derived values, right? Implied volatility is not something where it is like a stock where we have a stock transaction where there's a trade, somebody, pays this much to somebody who has the stock. So it's that's an observation, a transaction. Implied volatility is a benchmark. It's a derived value. And we could have based on how you're calculating it, the implied volatilities could differ even between platforms. And it's the implied volatility from the options. We call it implied vol because based on the option pricing model, it's an estimate of what the volatility, market estimate of what the volatility going forward, right, in the next 30 days. And I guess to make an analogy, let's say I'm a real estate investor and I'm trying to build a new construction home, right? Before I start, I'm trying to get an estimate how much will it cost. So I could get an estimate, $300 a square foot, $400 a square foot. But, obviously that's an estimate. You don't really know until you built the house how much it's really going to cost you, to the penny. You only know that when you're done and you have all your expenses in a spreadsheet. And it could vary, right? It could vary a lot, but you're getting this estimate, based on what a contractor, what he estimates, like that's what it costs. But once you have that benchmark, you could also compare that benchmark to a historical value. Well, I know how much, a house is for sale or sold, let's say. I know the square footage, so I could calculate how much that it traded at per square foot, or historical, how much somebody built a house and try to sell it per square foot. So what we're doing is trying to compare this forward estimate versus some historical benchmarks, or observations. So that's what the historical vol is. The historical vol is, how the stock behaved, what was the volatility moved, and what is the implied volatility? What is the estimate going forward? So under options, let's go take a look where we could see that. So under options on the main menu, click on options, click on option chain. Now we're on a Google options chain. I'm going to click on this menu to expand our screen. So the quick reference that we have is here, IV versus historical vol. So if we click on it, we get these different metrics, and this shows us where the current IV is, IV 30, 30.2. So this isn't looking at any particular one option. This is a benchmark based on the surrounding data. So implied volatility is 30.2. Where did the stock volatility, what did it look like in the most recent history? Right. So the 20-day was 22.4. The 252-day was 29.5. Okay, so we could see that going forward, the estimate for volatility is higher than the last 20 days. It's higher, close to the 252 days, right? So closer to its long-term volatility range. So this is a really quick way, without going into each option and trying to figure out, is the implied volatility high or low? We're trying to get a sense of where where the implied vol is based on that 30-day benchmark. Okay. And this helps, especially if you're moving from symbol to symbol, or you're interested in a stock because there's news, or there's a stock that you might think some kind of impact could be because of an upcoming event or announcement. You could kind of quickly go through and just see, okay, so now I see my benchmarks. I kind of have an idea where, implied vol right now is estimated to be around the stock's long-term volatility, longer term, 1 year, right? So it's kind of like in line. It's not way above it. It's not way below. It's kind of right there. If we wanted to see the IV 30 range in the last year, so on average, it's 29.8. The high is 57.3, low 20.3. 3. So now I kind of have a idea where we are relative to its high, low, and average. And then I could do the same thing for the moving 20-day historical vol in 252. So what this does is give us a quick reference, a quick way to get a sense of the general implied volatility, where we're at. And then we could kind of move on and say, okay, let me take a look at it further. Then you would go to a specific option, by going to the expiration and evaluate either a specific option or strategy. So I'm going to stop right there and throw it back to you. That was what I wanted to cover for today.
That was great, D. Thanks for bringing that to the Chameleon community as always. You have a great start to the week, my friend.
Great. Thanks, everyone, for joining. Stay safe out there and hope to see you tomorrow.
All right, we'll see you tomorrow, D. Thanks for everything. Bye-bye. All right, everyone. Thanks for coming in today. Please like and follow us on all the social platforms. If you are on YouTube, remember thumbs up. Remember to follow us. Then you'll be alerted to the webinars. Still trying to get these emails worked out as always when you're sending out a bunch. I don't know. The service we're using is not great. But with that, everyone, have a great, safe trading day, and we will see you tomorrow. Peace.